Let's do another video, shall we? Hey guys, how are you doing today? My name is Matt Gore, and we're going to do 3 stocks I'm buying this week. But first, let's hit the portfolio as always. Today, as I'm recording this on a Tuesday, we're actually up a little bit, so we're not doing quite as shitty as usual. I think earlier today I read about the Congress getting really close to a stimulus package for the coronavirus that's going on. I'm not monetized, so I can still say coronavirus. And thanks to that, we're actually up a little bit, even though we're down in the long term. I mean, 1,500 down is a lot better than 2,000 down. So let's hit the high notes here. Bank of America still down 28.77%. Cloudera up 14.71%. Cisco down 17.02%. Facebook 11.51%. Nordstrom down 40.9%. Now this one right here, I did hear that Nordstrom is cutting their dividends for the next quarter. And I bought Nordstrom for a dividend stock, so I don't know what I'm going to do about that. I think I'm going to wait until this goes up closer to my cost basis, or even at a profit, so I'm making some money. Then sell, take profits, and buy something else. Then we got Pfizer down 8.63%. We got Qualcomm 17.34%. Revolve down 41.78%. Sony down 19.43%, and Uber down 3.32%. Now, without further ado, let's get into the 3 stocks I'm buying. Alright guys, the first stock I'm buying is Facebook, ticker symbol FB. Now, you know exactly what Facebook is. That's the kind of name brand that they have. And if you don't know what Facebook is, well, your friends know what Facebook is. But you probably know what Facebook is. They are a growth stock to be reckoned with. Now, I want you to take a look at something. Right now, they're trading at 160. I want you to take a look at these monthly active users and daily active users. They are skyrocketing. They are skyrocketing quarter by quarter. Every single quarter is an increase in users. Every single quarter. Not a single drop. That's what you want to look at out of a growth stock. That's what you want to look at. Now, let's take a look at their financials. Now, their revenues growth has been going up and up and up since 2016. Just a constant flow upwards. It is skyrocketing. That is also what you want to see out of a growth stock. Their net income skyrocketing. Now, in 2019, the reason their net income is lower this time is because they got hit with some sort of tax court decision, the Altera Ninth Circuit opinion. Now, I don't quite know what that is, but I do know that it impacted their bottom line in a major way. And then the second thing is, earlier in 2019, they also had to pay the FTC in a settlement. I think that was due to the whole fake news thing that was going around. You've probably seen it in the news. But outside of that, their revenues are shooting up. Another interesting thing about Facebook is that they have no debt whatsoever. So that is not a problem. They have cash to handle pretty much anything. Absolutely anything. And look at their assets to liabilities ratio. Like, they are stocked for the long term. Like their financials are absolutely incredible. And another thing I want to bring up is take a look at this price to earnings ratio. As of their annual report, 32.89 to 22.22 over the course of the next year. That is very, very attractive. That is a very attractive price to earnings ratio. Now, it is a little high, as far as the industry average, but for a growth stock, 22.22, that's pretty good. Now let us take a look at their analyst predictions for the coming years. Right now they're trading at 6.43. For the end of fiscal year 2020, they are looking at a low EPS of 7.65. And a consensus of 52 analysts rate their average estimate at 8.99%. That is incredible. That is phenomenal. And you bring it into next year, you're looking at a low of 9.63 FPS and an average of 10.83. That is fucking insane. I'm not monetized, so I can still cuss. I mean, if you look at the revenue, right? I mean, 70.7 billion last year. They're looking at 85.05 for fiscal year 2020, and 101 billion for fiscal year 2021. Like, they've got some growth potential, and right now, because of the downturn from the virus situation, they are trading at a very low price. So this is a very, very attractive time to get in. Now, I'm not one to listen to analysts, target estimates, but they're targeting a 1-year estimate of 241.62. And if you go back to the analysts, they're looking at a growth rate of 20.5% over the next year. Now, a few caveats with the Facebook stock. Now, they did say in their 10Q that one of the risks is that over time, as they recruit a bigger and bigger user base, that the growth rate is going to slow down. That is understandable since there are only so many people in the world. It's just that at some point in the future, it will happen. And when the growth starts to stagnate, I imagine the stock price, wherever it's going to be, however high it is going to eventually start fluctuating. But I think we still got a good 3 to 5 years before that even happens. And another thing is that if you are looking at Facebook as a dividend stock, Facebook does not have dividends, and they stated in their 10Q that they have no plans on implementing dividends in the near future. Now, in 3 to 5 years, after the price stagnates, maybe in the future, but who knows, right? But anyways, that is my first stock that I'm buying. Okay, the second stock that I'm buying right now is Qualcomm, ticker symbol QCOM. Now, Qualcomm is kind of interesting because it's both, you can consider it both a dividend and a growth/value stock. My thesis on Qualcomm pretty much hinges on 5G. Now, 5G, if you're not aware, 5G is the new standard in mobile networking for your cell phones and all that stuff. That is going to be huge because that is going to enable more devices at one time to be able to communicate at high rate of speeds. That is going to be very useful for networked cars, communicate back home for various reasons. It's going to be useful for IoT, Internet of Things. There are a lot of cool things as far as speed and efficiency about 5G that Qualcomm is spearheading. That's why I'm pretty bullish on that right now. Let's take a look at the financials. As far as this, revenue is moving up pretty steadily. 2018, they had a bit of a loss. I haven't quite looked into that yet, but that's not the reason why I'm bullish on them. 2019, it's starting to head up. And if you look at Qualcomm's balance sheet, you can see their cash to debt ratio is pretty even. They got a little more debt, but I'm not too concerned about that. They have more assets than they have liabilities, so that's also a good thing if you're looking at a dividend stock. But look at these analyst estimates. This is where it gets interesting. This right here is where it gets a little interesting. The expectation is from the year ago EPS, they're expected to go from 3.4 to 4.09 for this year. But next year is when everything is expected to really blow up for them, because that's when 5G is supposed to really circulate commercially. So next year is the reason why we're buying this today. So we get in while the prices are low, and by next year, the expectation that these prices is going to shoot through the roof. Next year, they're estimated low estimate of 5.25 EPS, an average of 6.05 EPS. As far as revenue, we're talking from the current of 19.4 billion to 21 to round out the year. But next year, that is what we're looking at. That's our thesis right now. 27.52 billion, and that's with 25 analysts and consensus. The growth trend, we're talking about a growth next year of 47.90%. That is why I'm bullish on them as a growth stock. Now, as far as dividends, right now they pay a 3.9% dividend yield because of how low the prices are. That's not really important, but their annual payout 2.48 a share. Payout ratio, 59.94% of the profits. That does differ from the Yahoo payout ratio. I don't know why, I haven't really looked into that, but both of those are fair, though. So they're below the 75%. They have been growing their dividend each year. They are a fairly reliable. They seem to be a fairly reliable dividend play. They actually been growing their dividends substantially over the years, so that's pretty cool too. So all in all, I think that Qualcomm makes for a nice dividend and a growth stock. Like, they even have customers like Samsung and Apple on board. So, and those are big players in the mobile game. And Apple, Apple and Qualcomm were in a settlement that Apple lost in 2019. Apple just signed a 6-year licensing agreement with Qualcomm, so all Apple's phones are going to have the Qualcomm chipset. So, I mean, that is a massive win for Qualcomm. Anyways, that's my thesis, and that's why I'm picking Qualcomm as the second stock that I'm buying this week. All right, and the third stock I'm buying is Revolve. Ticker symbol RVLV. Now, I am not into fashion whatsoever. I mean, I would never have heard it. I would never have checked out this group if I haven't heard it through the grapevine. And originally, I wasn't going to get into this stock at all. Again, fashion just really isn't my thing. Then I started looking into it and looking into how they do things. So one thing I like about Revolve is they use big data in order to manage their inventory and their pricing. Now, what does that mean? So they use big data like Cloudera or Apache. I'm not sure what they use, but basically they use computer algorithms to spot trends, and they use that to determine what kind of inventory that they need to put out at what given time, or how much to charge for a certain article of clothing. It's working. If you look at their financials, right now they're reporting a 53% gross margin in 2019. So that means out of their revenue, they are keeping 53.6% of it before they go into the operating cost. That is pretty good. And you can also see that the average person that goes on to, or that shops from Revolve, the average person will spend $275 on a purchase. Another thing that I like about Revolve is that they don't use brick and mortar stores at all. All of their sales and stuff are done through digital channels. As far as their marketing, they market through, instead of marketing the traditional way, they market using Instagram influencers. And I think that is very, very smart. Yeah, I had to get in on this. So right now they're trading at $8.56. So they've got hit pretty bad due to the whole virus situation. You can see ever since they came on, they are gaining revenue. They are exploding in revenue. As far as their net income, I mean, you can see the start of a great company in progress. I know they founded it in 2013, and they only recently went public. So you can see profits are going up. As far as a balance sheet goes, I mean, check it out. You don't see debt on here. They have no debt, so that is a very good position for a company to be in. So they're in a good position to weather any downturns. And if you look through the assets to liabilities, yeah, they have nearly twice as many assets as they have liabilities right now. So that is pretty good. So right now, this year's going to be a little difficult since they've, they're being hit with the virus situation. So right now, a pretty modest growth this year from this to, now they may lose some this year. Their EPS is going to increase modestly. Now, as far as their revenue, they're expected to go from 600 to 800 next year, which is, we're holding stocks for a 3 to 5 year period. And as far as next year, they're projected to have 32.70% growth. So all in all, I think Revolve is a pretty good place to park our money, and especially when their stock is trading for such a cheap price. As far as forward PE, they just went public, so they don't have a trailing PE. They do have a fairly expensive forward PE, so that's something I'm going to keep my eye on. But I think they have growth potential, and you know, I'm looking to see where this company is headed within the next 3 to 5 years. Those are my 3 stocks that I'm buying this week. I hope you enjoyed the video, and you guys have a great day. Eat your vegetables.